Okay. So now let's go to the market. So this looks like a real uptrend to me, a nice consolidation that we can jump off of. I mean, it's been a huge uptrend. We know that. This is the Andrews fork we're following. We stay in the uptrend. We tested the 50-day twice and it held, and the market closed on the up note. All right. Newsflash. I think that if there's a couple of thoughts here. First of all, institutional money managers love to mark up their portfolio into the end of the quarter. That's June. Into the end of the half of the year is over, right? Into 4th of July weekend. I mean, these are just all seasonal things that are bullish. I don't put money to work because of that. But if we have a risk on buy signal in the risk monitor that starts to produce into that time period, we know that that seasonality is a wind behind our back or beneath our wings or whatever. Okay. So 2 weeks ago, the risk monitor went green. We picked up on this trend before it really started. That's the beauty of the ARMR investing way. I remember a couple of weeks ago, we had some debates with some insiders, and other guys on YouTube were talking about doom and gloom and the market's about to implode. And what I said then is, I don't predict the market. I don't know what's going to happen next. All I do is put capital to work when reward's worth the risk and the probabilities are in my favor. How do I get probabilities in my favor? ARMR algorithms, which I share with you. When we get confluence across the 8 indexes. So it's not just one algorithm of one index. It's confluence across them that tells us the probabilities are at their highest, that institutions are buying the market. And that's what's going to drive the market up. Institutions are the elephants. They're starting to stampede. We're the cheetahs that are running between their legs. We want to get out in front of them. We don't want to get stepped on them. So we did that 2 weeks ago. We have alpha in our portfolio now in the last couple of weeks. It's starting to accelerate. This is beautiful. We don't have to chase the market. People who were afraid 2 weeks ago and did nothing now find themselves with way too much cash in the portfolio. And now what do? Well, they start chasing. And hey, it may work because the month of June, I think, is going higher, but it's the wrong way to run money. And you're missing an incredible opportunity to get yourself set up for the move so that you're dictating to the market and the market's not dictating to you. You put capital to work when everybody's afraid. And when everyone starts talking about what a great bull market we've got, you know that's the time to start managing your success. It means selling a piece or all, depending on the type of investor and trader you are, of your gains on big up mornings when there's elation, because those are the days we'll be hitting targets. You can look at the ARMR spreadsheet. You'll see what the targets are, hitting targets. That's the morning to book some profits. It'll be here at some point. It's not this morning, but there'll be a morning when the market gaps up 1% and is up 1.5%, 2% in the first 2 hours of trading. And everyone's just, oh, ecstatic. Everyone's just, let's buy everything in sight. That's when we'll be selling into it. Okay. But right now, it looks to me like the market is about to jump off of a really nice consolidation. And if we look at QLD, which is twice the performance of the triple Q, that's a nice cup and handle. It's about to break out. It hasn't even started yet. If this thing takes off, we're going to see some serious alpha in the portfolio. If it's going to take off, if I'm right about what I think is happening based on ARMR algos getting us in correctly, based on the seasonality of what's going on, and based on gamma information, right? So gamma information is becoming more bullish. And just so you understand why I don't just use gamma information, it's because 2 weeks ago when we were buying the market, gamma information was negative. So it's just a piece to the puzzle. It's our job to put all these pieces together and get a picture. Now gamma is beginning to show up in a positive way for us. So what I intend to do, I've got conservative portfolios I run. I have aggressive portfolios I run. For you, I've created the spreadsheet with 3 sections. Depending on the stock I'm buying, I put it into a lower risk, higher risk, lower risk, moderate risk, highest risk type of investment. Okay. When we start buying stocks 2 weeks ago, they're lowest risk, moderate risk type of names, which means to me, a lot of liquidity. Microsoft to me is a lowest risk type of name. Tons of liquidity, easy to trade. Okay. If the market implodes, it's not going to collapse on me overnight, theoretically, right? Okay. That can always happen, but you know what I mean. Microsoft is over here. On the, in the moderate side, you might find some names in the moderate part of the portfolio that are kind of strange, like US Steel and Cleveland Cliffs. But look at how they trade. Wild volatility, right? So that ups the risk to me. If the distance from the stop loss is further, if the volatility of the asset is greater, then it goes into the different segment of the spreadsheet. So Coca-Cola, Microsoft, the energy pipelines, McDonald's, obviously these are lower risk names. Then we've got some of these industrial names. They're not highest risk, but they got a lot more volatility, right? You could see US Steel drop 10% in like, I don't know, half an hour. All right. So you have to recognize that risk. And then, of course, what I'm going to be doing now is filling out the higher risk end of the portfolio with innovator type of names. So this is what I'm trying to say this morning. If the market is going to melt up into the end of the month, end of the quarter, July 4th weekend, all this kind of stuff, I expect the innovator type of names, which have been dragging this market down, to start kicking in a bullish way. And so those are the names I really want to focus on now if I add things in the portfolio. Aggressive portfolios I run, what I'll be looking to do is reduce my conservative positions, which means I'll be booking profits, right? And rotating the money into these innovator names. Okay. Innovator names carry smaller position sizes. Lowest risk names carry double the position size based on volatility. It's pretty obvious. You understand how I'm doing that. So you figure out a position size that works for you. It doesn't have to be mine. But my point is, if I'm adding highest risk names to the spreadsheet, please understand that for me and the way I run money, that means the position size is smaller. Okay.